Hello traders and investors, welcome back to the Trend Trader channel. In today's video, we will be doing a book review, but in addition to the book review, we will be talking about retirement planning, right? Before we start, I would like to encourage those who haven't subscribed to consider subscribing. And if you find value in this video, please smash that like button, and also feel free to share this video with as many people as possible. Right, the book that I want us to focus on today, it's this book. This book speaks about retirement planning. I will leave a link where you can get this book. You can buy this book from any bookshop. You can even buy it on Take-A-Lot or Loot. So this book is the ultimate guide to retirement in South Africa. The good thing about this book, it is written by South Africans. So most of the things that they talk about in here are applicable to South Africans, because sometimes you can buy an international book and then they start talking about products and services that are not available to South Africans. So now that we want to talk about retirement planning, the most important thing that you need to do before you plan for retirement, you need to consult a professional financial advisor or professional financial plan. But you also need to get guidance from a tax person, because there's tax that is involved when it comes to retirement planning and stuff. So some of the things that are discussed in this book is some things that you need to take into consideration when it comes to retirement. Things such as how much money you need to retire on. For some people are employed, some people are self-employed. So you need to have an idea of how much money you need to have at the end of your working life. And then the other things that are discussed, such as tax and retirement, and also investing for income. And then the last chapter of this book, it's about estate planning. As we know, we're not going to be here forever. Okay, so I highly recommend this book. Like I said, you can buy it at any bookshop. This one, we got it at not at Brooklyn. We got it at Exclusive Books. At that time, it was about 308 rand. Due to inflation and the supply and demand of the book, the price has definitely changed. But you just make sure that you grab yourself a copy of this book. Okay. So now, what I want to talk about when it comes to retirement planning, especially for people that are either employed on a fixed-term contract, meaning that they're not contributing to pension, or the employer is not contributing to pension, but also people that are self-employed. Because if you are self-employed, then things are a bit different. So if you are not contributing to a company, or there's no company contribution towards your pension fund, one of the ways that you can use to contribute to pension, and this is the tax efficient way. Once again, this is not a financial advice. Make sure that you consult a professional financial planner or financial advisor, and also you consult a tax planner. Okay, so one of the tax efficient ways for saving or investing for retirement is through a retirement annuity. Okay, so if you have money, you can decide to save money or invest money, and then you can use that money for whatever that you want to do, because at the end of the day, it is your money. But when it comes to retirement, you need to take into consideration your current lifestyle. What kind of life are you living at the moment? What is your income? And then once you stop working, how much of your current income you would like to get each and every month, for as long as you remain alive, and also since you won't be working at that time. So you need to have an idea of how much money you need. So a tax planner, not a tax planner, a financial advisor or financial planner will help you to determine that amount that you need. Then once you know the amount, then you can start investing in different kinds of things that you can invest in, meaning that one of the things that you can invest in is a retirement annuity. Like I mentioned, that it is a tax efficient way of investing. Why retirement is a tax efficient way for retirement investing is because the contributions are tax deductible. So now you're not just gonna throw in all the money that you have towards your retirement annuity, or RA for short. You can deduct up to 27.5% of the money that you contribute, or to about 350,000 rand per year, whichever is greater. So depending on your income, maybe 350,000 per year, it's possible. Per tax year, it's possible. Or that 27.5% is possible. We have different levels of income. That's the reality of life. So In a retirement annuity, what you can buy, RAs come from different service providers, financial service providers. If you're using these equities, now there's a retirement annuity tab where they have a different retirement annuities that you can buy. But other companies also do sell a pension product, including retirement annuities. Some of the companies that people may be familiar with are like Sanlam, PSG, Old Mutual, Liberty. It's a whole lot of companies. There are even some boutique funds that choose maybe the entry to those funds it's a bit different because of the amount that they require from their investors. But there are plenty of financial service providers that you can use to buy retirement annuity. I've already mentioned the tax benefit of a retirement annuity. Then now, what can you buy inside the retirement annuity? Usually retirement annuities, they are sort of mutual funds. They have something that looks similar to unit trust, or they can just give you unit trust. But when we say funds, it's just a collective investment scheme whereby the investors put their money, then the fund managers invest in different products. One of the common things that people normally invest in, it's a balanced fund. So what is a balanced fund? A balanced fund, it's a blend of equities, some maybe physical property, something such as cash and cash equivalent. It could be money market fund, it could be bond, it could be interest bearing account, but it's just a combination of different asset classes. The advantage of investing in a balanced fund is that we already know that different assets are going to perform differently over time. So sometimes the equities outperform the bond market. Sometimes the bond market outperform the equities, but usually that is just in the short term. In the long run, historically, equities have outperformed a lot of other different asset classes. Remember, previously this data previously there was no such thing as crypto or Bitcoin, and then with the emergence of cryptocurrencies, then things might have changed a bit. But you get the idea that a balanced fund is just a blend of different asset classes. Then depending on your age and your need, then with your financial planner, then you can decide maybe to invest in a bond only fund depending on your risk appetite, and also taking your age into consideration and how much money are you going to need. Because if you're conservative, then you don't want your money in an aggressive fund where there is a large volatility. By volatility, we simply mean that the spikes, that the value of the fund will keep on fluctuating up and down. Okay. So now, these mutual fund or unit trust or collective investment schemes, usually there's a fund manager that makes the decision on behalf of the investor of where the money is going to be invested. You as an investor, you are just investing in a balanced fund, but the fund manager decides the portfolio allocation, how much capital goes into equities, bonds and other stuff. And also within equities, which companies are going to be bought and everything. And then also those fund managers need to work, they need to be paid and stuff. Then there are fees, right? So it's common that the fees for mutual fund are somewhere around 1% and 3%. Some of it can be negotiated, some of it cannot be negotiated. So if you can negotiate a lower fee, lower fees are much preferred, because over time, the impact of the fees, it starts to show in your investment, okay? But usually, mutual fund has fees that are more than 1%, which is big compared to other things that you can invest in. But remember that if you invest in a retirement annuity, your contributions are tax deductible. So you need to think about the tax benefit of investing in an RA, and also the fees that you'll be getting there, and also the horizon, because if you are like 25 or 30, you still have a long, well, any time is a good time to become an ancestor, but on paper you still have a long time to live and contribute there. So over the long period, you are more likely to end up with more money compared to what you are starting with, okay? And then another thing that you need to take into consideration is that if you invest in a retirement annuity or any pension plan, you're only going to get that money once you reach a certain age. In a retirement annuity, you need to reach 55 years. Then you can then start to withdraw some of the money from there. If you want to withdraw that money before you turn 55, there are some conditions. If the total contribution is below 15,000 rand, then you can get that money. Not sure if there's going to be penalties, but if the money is greater than 15,000 rand, then it becomes difficult, because even if you can manage to get that money, there's going to be a large penalties. So that is something that you need to keep in mind, that once you decide to buy a retirement annuity, you're gonna stay invested until you reach at least 55 years. Okay, we mentioned the tax benefit, but that does not mean that you won't be paying tax on your retirement annuity. Once you reach 55, you have the option of withdrawing 30% or a third of your total contribution, 1/3 to simplify it, but that a third of that withdrawal is going to be taxed. However, the tax is going to be calculated at that time. Then the remaining 2/3 or 67% of your total, you will have to use that money to buy an annuity. So that annuity, there are two kinds of annuities. There's a living annuity. I forgot the name of the other annuity, but it simply means that you will use the 2/3 of that money to buy a pension, whereby you'll be drawing an income once you are no longer working, or whenever you decide to start drawing from your retirement annuity after the age of 55. So that is something that you need to keep in mind, is that with the retirement annuity, there are tax benefit, it's tax deductible, your contributions, but also you need to keep in mind that you're only going to get back that money once you reach 55 years of age. It doesn't mean that you need to stop working at 55. If you want your money at 55, then you can start getting your money, but you can only get 1/3 of your money, which is going to be taxed, and then the 2/3 will be used to buy an annuity. Then the income from that annuity is also going to be taxed. We also mentioned that the fees are a bit higher when you're buying things like mutual funds, because the fees are greater than 1% total expense ratio. Okay, so what is the other alternative? The other alternative is to invest in exchange traded funds, ETFs. But remember, retirement annuity, it has tax benefit. If, for example, you decide that you want to invest in ETFs, because there are some balanced fund ETFs, the advantage of ETFs is that the total expense ratio is lower. Right now, the JSE Top 40 tracking ETF is not a balanced fund, that is an equity fund, but you can find some ETFs that blend equities and other things. Then you look at the total expense ratio. The total expense ratio could be lower. But remember, if your retirement annuity, you can't buy an ETF which will have a lower fees, then it means that you can't buy ETFs in a retirement annuity. But if you have a stock brokerage account, you can consider buying ETFs in a tax-free savings account. But keep in mind that the tax-free savings account, it has a limitation. In a tax year, you can only contribute 36,000 rand. Remember, we said that with retirement annuity, you can get a tax rebate of up to 350,000. So 36,000 is insignificant. It's like 10% of that 350,000 that you can get there. But another thing that you have to keep in mind, the fees can be low. You can buy the ETFs in the tax-free savings account, and then you can still buy the ETFs in the normal brokerage account where there is no tax benefit, meaning that every time you receive distributions, you are going to pay that dividend withholding tax, which is 20%. Another advantage of buying a tax-free, not of buying tax-free savings account, another advantage of buying ETFs in a stock brokerage account is that you don't have that limitation of getting your money when you turn 55. Whenever you want your money, you can get your money. And if you want to improve the tax efficiency of your ETFs in a normal stock brokerage account, then you need to hold your ETFs for at least 3 years. But remember, how they calculate tax, if you're going to be contributing monthly, it means that every time you contribute some of your shares, that 3 years keeps on getting extended. When you do your tax, you can do FIFO, or you can take the weighted average of that basis cost, or cost basis, whatever they call it, but the price that you paid for that asset, and then when you dispose the asset, because that will trigger capital gain tax. It's a capital gain tax event. But that is something that you need to keep in mind, that there are some benefits to buying ETFs in a stock brokerage account. You have the option of investing in ETFs in the tax-free savings account, and then you can buy more ETFs in the normal stock brokerage account. The total expense ratio for most ETFs is less than 1%, and you can get your money before you reach 55. So you need to do whatever works best for you. None of this is financial advice. Make sure that you speak to a financial planner, and you also get a tax planner so that you can get the best advice in there. So that's it that I wanted to share with you, some of the options that you can use to plan for retirement, and you can get more information in this book. Like I said, I will leave a link to this book. I will just leave a Take a Lot link, but you can also buy this book at Amazon or at any other bookshop. So that's it that I wanted to share with you today. We've already made a couple of videos where we were looking at the difference between the Satrix Top 40 and the All Share Capped Index ETFs. We also spoke about Vanguard ETFs that one can use to plan for retirement. For example, we mentioned that the VOO ETF, which tracks the S&P 500, it only has a total expense ratio of 0.03%. So it's pretty much like you are getting it for free. But the fee is there, it's just that the fee is so insignificant. So I will leave a link to all those videos in the description below. Once again, if you haven't subscribed, please consider subscribing. And if you found value in this video, please smash that like button, and feel free to share this video with as many people as you can. If you have comments or suggestions, please leave them in the comment section. If you have anything that you want to add when it comes to retirement planning, retirement annuities, ETFs, please write those in the comment sections. We respond to each and every comment, and that helps us to create more content that our viewers and subscribers are interested in. So that's it for today. I will see you in the next video.